Hello everyone and welcome to ACC F6 Singapore Tax. Today we are going to cover wear and tear allowances. Wear and tear allowances is a replacement for accounting depreciation that businesses have charged in statement of profit and loss. Why there is replacement for accounting depreciation? This is because accounting depreciation can be manipulated, can be increased or decreased by companies, because that's totally decision of the businesses. So changing the amount of accounting depreciation will change the amount of profit and hence change the amount of tax. So this is not allowed. Tax authorities do not agree with amount of accounting depreciation that businesses have charged in statement of profit and loss. Tax authorities would ask businesses to add back all the accounting depreciation, and instead of accounting depreciation, tax authorities will allow something else that businesses can deduct from their profit in arriving the taxable profits, and that is your capital allowances, or you call it wear and tear allowances, or you can call it tax depreciation. So let's get started. First of all, let's define what is wear and tear allowance. So wear and tear allowances. Okay, this is actually your tax depreciation, or you can call it capital allowances. So you will come across different names, but they all mean the same. Okay, so this is the amount of depreciation allowed by the tax authorities. This is amount of depreciation allowed by tax authorities that can be deducted from profits of the company in arriving taxable profits. Okay, taxable profits. So that's your wear and tear allowance, or you call it tax depreciation. Now we know that accounting depreciation is charged when businesses purchase non-current assets. So similarly, tax depreciation is also available on the purchase of non-current assets. So businesses can claim capital allowances on expenditure incurred on non-current assets. So examples of non-current assets, you can have buildings, you can have machinery, you can have cars, okay, etc. So on non-current assets, businesses can claim wear and tear allowances. Now in F6 Singapore tax, we have two different wear and tear allowances available. The first one is section 19A, capital allowances available under section 19A, and secondly, capital allowances available under section 19. Both will provide different amount of allowances. So we are going to cover section 19, capital allowances. These are basically normal allowances available to non-current assets without any concession. Okay, so section 19 capital allowances, they are available over the life of the non-current assets. These allowances available over the life of asset means the life of asset with the cost of asset can be divided by the life of asset, and that's the amount of depreciation. Now please do not think that it is same as straight line depreciation, because the life of asset will be determined by the tax authorities. So it's not actual useful life of non-current asset. It is the life of the asset is determined by the tax authorities. So life of asset is determined by IRAS, which is Singapore's tax authority, right? So and it is given, life of assets is given in 6th schedule. It is a document available on IRAS website if you want to visit. And the life of assets is fixed by tax authorities. For example, life of motor vehicles is fixed as 6 years. So whenever you want to claim Section 19 capital allowances over for the motor vehicles, okay, for the cars, you consider the life of cars as 6 years. Okay, it may actually be more or less than that, but for the purpose of capital allowances, we are going to fix it at 6 years. Now this is Section 19. Then you have another section which is Section 19A. Section 19A, and these are accelerated allowances. Accelerated allowances. Now, what is accelerated allowance? Some concession is provided by the IRAS that you can claim more capital allowances or greater amount of capital allowance for purchase of non-current assets. And under Section 19A, you have three categories. First of all, businesses have a choice to claim 100% capital allowance. 100% capital allowance means all the cost of the asset can be written off as tax depreciation in 1 year. Okay, so that's 100% write-off. 100% write-off in 1 year. That's one concession. Okay, so if businesses let's say want to claim capital allowance under Section 19, so they will have to spread the cost of asset over the useful life. So every year there's going to be some small charge, small capital allowance available. However, there is a choice given by IRAS that certain assets can be written off in 1 year 100%. Okay, so there is a huge amount of capital allowance available to the businesses. Then you have another concession, another choice. Businesses can claim allowances. Over 3 years. Okay, so no matter whatever is the life of asset, businesses can claim allowances over 3 years. Okay, so that's also a greater amount of capital allowance available to the businesses. Like I said, if you buy a car, so car has useful life according to tax authorities of 6 years, but and that means small amount of cost will be available every year for 6 years. However, businesses have a choice to claim capital allowances over 3 years under Section 19A. So every year a greater amount of capital allowance will be available to the businesses. Okay, so these are the two choices available under Section 19A. Now you have to remember Section 19. This is available all the time. Okay, there is no restriction. So available to all non-current assets. Okay. However, under Section 19A, this is available on certain assets. Available on certain assets. It's not available to all assets. Available on certain assets. Only if you satisfy the conditions for 100% write-off, you can claim 100% write-off. Otherwise, you cannot claim. And claim over 3 years. This is also available on all non-current assets. Available on all non-current assets. So businesses have a choice that is always available, either to claim the capital allowances under Section 19A, which is over useful life, or claim it over 3 years. So these two choices are always available. However, to claim allowances over 1 year, that is 100% write-off, It's only available on certain assets, and we will go through what those assets are. Okay, so first of all, I want to cover section 19, which is capital allowances over the life of the asset. Okay, section 19. Section 19, wear and tear allowances, or wear and tear allowances. Okay. Now, first of all, we have to determine what is the cost of asset on which allowances are available. So, is it just the purchase cost, or there's something else included? So, I will list down the items that will be part of your cost of asset when it comes to claiming the capital losses. So, this allowance is available on cost of asset, but we have to define what cost of asset is. Cost of asset. Okay, cost of asset includes the following. So first of all, you have the purchase cost. Then secondly, you have any insurance that you're paying on the non-current asset. Then you have certificate of entitlement. Certificate of entitlement. What is certificate of entitlement? The asset has been registered in business name. Okay, so the ownership of the asset has been transferred, and that documentation is your certificate of entitlement. Delivery cost. If you are buying the asset from, let's say, a foreign country, the delivery cost carriage inward will be your part of your purchase cost or the cost of asset, and any alteration expenditure, so all of this will be part of cost of asset when it comes to claiming the capital losses. So we will have to total all of this. Okay, now under section 19 there are two allowances. Two different amount of allowances are available. First of all, there will be a different allowance available in the first year of the purchase. Okay, so when businesses are going to purchase the asset, they will claim initial allowance. Okay, and then in the subsequent years they can claim annual allowances. Okay, so we are going to claim initial allowance. Section 19 provides initial allowance, you call it IA, and annual allowance. Okay, annual allowance, AA. Now, initial allowance is available. It is available in the first year only. Okay, it is available in the first year of purchase only. Okay, and annual allowance, it is available in the first year and subsequent years. Okay, it is available in the first year and subsequent years. Okay, there is a different method of calculating initial allowance and annual allowance if the asset is purchased for cash. If the asset is purchased on lease or hire purchase, then there's a different method of calculating initial allowance and annual allowance. So let's first cover how to calculate initial allowance and annual allowance if the asset is purchased for cash. Initial allowance and annual allowance if asset is purchased for cash. Okay, so how to calculate initial allowance? Initial allowance is calculated as follows. Initial allowance is equal to 20% of cost of asset. 20% times cost of asset, and we have already determined what cost of asset is. That is mentioned on the top. It includes purchase cost, insurance cost, certificate of entitlement, delivery cost, and any alteration expenditure. So that's your initial allowance. And your annual allowance is calculated as we know that only 80% cost of asset is remaining. So we will take the 80% times cost of asset. 80% times cost of asset, and it has to be divided by life of asset. Okay, so this will be available in the first year as well as in the subsequent years. So let's see how we can apply this in a given example. Okay, so let's say example is Zenith Limited prepares its accounts to 31st January annually. During the year 31st January 2013, the company bought a heavy machinery costing $100,000. So the requirement is to calculate initial allowance and annual allowance available. Okay, that's what we have to calculate. So how much initial allowance will be available? It's going to be initial allowance is equal to 20% times cost of asset, right? 100,000. So it's going to be 20% times 100,000. That gives us 20,000. Yes, so that's the initial allowance available in the first year. Available in first year. Then annual allowance. Annual allowance is going to be 80% times cost of asset over life of asset. Okay, so let's assume here life of machinery here is 10 years according to 6th schedule. Okay, so in this case, if the life of asset is 10 years, how we are going to calculate the annual allowance is going to be 80% times 100,000. 80% times 100,000 over 10 years. And that gives us, if you calculate, it's going to be 80,000 divided by 10 is $8,000. Yep. So this is available in first year as well as subsequent years. Available in first year and subsequent years. Okay. So how much allowance will be available in the first year? Total allowance available in first year is going to be the first one, initial allowance, which is 20,000, plus you have 8,000 from the annual allowance. So total allowance available in the first year is 28,000. Total allowance available every year in the subsequent years, available in subsequent years, it is 8,000 per year, right? So that's your initial allowance and annual allowance calculated if the asset is purchased for cash. Okay, now we are going to see what happens if the asset is not purchased for cash. Instead, asset is purchased on lease or hire purchase agreement. Okay, so I'll go to next slide. Initial IA and annual allowance AA if asset is purchased on lease or hire purchase. Okay, hire purchase agreement. Okay, so first of all, you have to determine how much cash has been paid for the asset in a given year. So because it's only available on the amount that business has already paid, it's not available on what business is going to pay in the coming years. So you have to determine how much amount has been paid. It can include the deposit paid, or it can also include any installments paid during the year. So you can only claim allowances on the amount that you have actually paid. Okay, so first year initial allowance in this case will be, the formula is same, it's just that you have to determine how much amount has been paid. So it's going to be 20% times, not the cost of asset, it's going to be deposit paid plus all installments paid during the year. Now business may also be paying interest payment on the lease, but so interest is excluded when we want to calculate the allowances. So excluding interest payments. Okay, so we are only going to take the principal amount that we have paid, excluding interest plus any deposit paid. So we take 20% of that, and that is your initial allowance. Okay, annual allowance is going to be same thing, 80%, okay, times cost of asset divided by life of asset. So in this case we are going to take the total cost of asset, not the amount that we have actually paid, in order to calculate the annual allowance. So that's how you calculate the allowances if asset is purchased on lease or hire purchase agreement. Okay, so let's just take an example now. Okay, example is let's say a superstore limited, a business acquired a plant on the following terms. Okay, on the following terms, the cost of plant is, let's say, 250,000. Then you have deposit paid. Deposit paid was, let's say, 120,000, and amount of finance available is 180,000. And terms of payment, let's say we have to pay over 2 years, so 24 months. Okay, and monthly payment of 7,500, excluding interest. Okay, this is excluding interest. So the company has year end of 31st December. The deposit was paid in January 2013, and first installment was due on 31st January 2013. Yep. So, and the requirement is to calculate initial allowance and annual allowance. Okay, calculate initial allowance and annual allowance. So let's try that. How to calculate the initial allowance and annual allowance in this case. So first of all, we want to know how much deposit and how much installments we have paid during the year. Okay, so actually we have paid the first payment, the deposit was paid in 2013, January 2013. So okay, so let's calculate now how much total payment has been made in year 2013. Okay, so first of all, deposit paid is 120,000. Okay, and how many installments paid in 2013? Installments paid in 2013. So that includes, if you see, the first installment was paid in Jan 31st, okay, 31st Jan 2013. So that means 12 installments of 7,500 has been paid during 2013. Agreed? So that will be equal to 12 times 7,500, 90,000. So total amount paid in 2013. Total amount paid in 2013 is equal to 210,000. Okay, 210,000. So now we have to calculate allowance on this amount. So initial allowance is equal to amount paid times 20%. So 20% times amount paid is 210,000. That equals 210 times 20%, 42,000. Okay, 42,000. If you calculate, it should be equal to 42,000. And what about annual allowance? Annual allowance is equal to, now in this case, annual allowance will be is available on the cost of asset. Again, 80%, okay, times cost of asset. Now cost of asset is, you see, if I have paid deposit equal to 120 and finance available is 180, that means the total cost of asset is 300,000. Not, please don't take 250 because we are not purchasing on cash, so that is irrelevant. The total cost we have to pay is 300,000. So 300,000 times 80% divided by the life of asset. Again, I'm going to assume here that life of asset is 10 years. Okay, life of asset is 10 years. So that will give us a total figure of annual allowance, 300,000 times 80% over 10 is 24,000. Okay, per year. So that's your total initial allowance 42,000 and annual allowance 24,000 per year. So that's how you calculate the initial and annual allowance if the asset is purchased on hire purchase agreement.